The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Okay, just give me a second. Sorry for the delay. Just had some minor technical issues, but everything's all okay now. All right, just want to make sure you can hear me loud and clear. And also, please note, if you have any questions, you can drop them in the chat box or in the Q&A window. Right, okay. Hi, everyone. Okay, let me see. Okay, webcam sharing and attendees. All right. Okay, hi, everyone. Okay, oops. All right. Okay, so, okay, we are good to go. All right. Okay. Okay. Apologies for the delay, but yeah, here we go. We got everything ready now, and okay, we're all set to go. All right. Okay. Hi everyone. Good morning. Good afternoon from wherever you're tuning in. All right. Hi John. Hi June. Calvin. Min. William as well. Who else we got? Yeah, all right. Nice to see some familiar names as well. All right. Welcome back, everyone. Okay, just want to make sure you can hear me loud and clear, and then we'll start off. Okay, so first of all, of course, we have the disclaimer. So all the opinions expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of XM. XM does not guarantee the accuracy or reliability of the information provided herein. And of course, do take note of the risk warning that comes with trading margin FX and CFDs, as they carry significant risk and is not suitable for all investors. You could lose substantially more than your initial investment. Okay, right. Okay, so my name is Ketan Rameshchandra. So this webinar series is brought to you the special partnership with Everest Fortune Group and XM. So Everest Fortune Group has been the finalist for Best FX and Equity Research for the following years, right? 2019, 2020, and 2021. Okay, so here's just the agenda for today, right? So it's an introduction to. Oh, I did my okay. Wait, hang on. Yes. Okay, so introduction to forex. So we'll just start off with a few data resources where you can get information regarding forex and central banks and any other info like that. Then we'll look at which are the major central banks. How do we look for the what are the monetary policies? How do we look for meeting schedules and what are interventions? Then we can also look at some of the economic data. No, sorry, we look at dollar index first. What is the dollar index and what does it consist of? Then we'll just cover some of the economic data that is driving the moves in currency markets this year. Right? Okay. Just let me check. Everything else is right. Okay. Sorry. Okay. So right. Okay. Um, I suppose most of you should be familiar with Forex Factory. Right. Forex Factory is a good website for identifying the major economic events that are coming up. So they have a very good economic calendar. So if we switch over to Forex Factory now, yes, okay. So this is Forex Factory here. Right, if you just Google for Forex Factory, you'll find it. So okay, so today is the 4th of July. So U.S. markets are going to be closed, so we can expect lower trading volume in the latter part of the day. Okay, so as you can see, today we have a pretty big uh, cash rate announcement by the Reserve Bank of Australia, RBA. So what I'm going to do is I'm going to switch my time into GMT, so it's easier for everyone to relate to, no matter from which time zone you're tuning in. So I'm going to switch mine to GMT, and I'm going to go look from today till Friday, and I'm just highlighting the two most impactful events. Okay, just to take note of what are the key events coming up this week. All right, so in about an hour and a half or 1 hour 20 minutes, we have the RBA announcing their cash rate announcement. Okay, so they have the current cash rate stands at 4.1%. Okay, so if and it's very likely they are going to keep interest rates or their cash rates steady. They're not going to raise rates because we saw last week Australian CPI data started to retreat quite sharply. So because of that, it's very likely that they will not increase the cash rate at today's meeting, and their statement and policy outlook could be quite dovish as well. So this would mean uh, negative. This would be negative for the Australian dollar. So it's quite likely we may see the Aussie dollar uh, fall once this news is released, and we also have to see what is their statement uh, and how dovish is their statement, right? So we could potentially see the Aussie dollar fall today at 4:30 a.m. GMT. Okay, and we have FOMC meeting minutes. This is tomorrow 6 p.m. GMT. So tomorrow 5th July US markets will resume trading. So we'll have back to normal trading volume as well. So there's more liquidity tomorrow. Today is going to be relatively quiet in the second half of the day. Then we have jobs data coming up this week, full of jobs data from the US, right? ADP non-farm unemployment claims, and also, of course, non-farm payrolls on Friday. So the data is important to take note of data events like these because they will definitely have a huge impact on currency markets, right? They provide a strong catalyst for continuation of trend or perhaps even reversal of trends, right? So that's why it is important uh, to view the calendar at the start of each trading day and then identify the main events that are coming up for the week, because then at least you're able to uh, pin it on your calendar, the date and time, so that you're aware of such potential catalysts that could drive markets very strongly, right? Is There are high volatility events. Okay, this is Forex Factory. Um, And in terms of, okay, the good thing about Forex Factory is also because if you click on the folder icon and you click on latest release, it takes you to the website of that respective central bank or that data source. So in this case, it takes us to the RBA's website where you have more information on their cash rate target, uh, their statement as well, and the minutes, and also you are able to view the calendar as well, right? The meeting calendars, when the next meeting is going to be announced, and so on and so forth. Okay, so that's the good thing about Forex Factory. So similarly, if you want to look at non-farm payrolls, you click here, then latest release. It takes you to the Bureau of Labor Statistics, right? Of course, and this you have all the details here. But what we usually want to go to is looking at the news release charts because it's easier to visualize the information. So you can see here they'll have the unemployment rate. And if you want to look at uh, non-farm payroll, it would be under this, I believe, employment by industry. Is it this one? I don't know. Yes, okay. So if you look at under employment, establishment survey data by industry, and you click on go, you will have the total non-farm payroll number coming up in dark red here. Okay, so this is the good thing about Forex Factory. And also do take note, Forex Factory, they also have the forecast for that particular event and the previous month's reading as well. So, for example, for non-farm payrolls, right? Last month's reading was 339,000, which means 339,000 jobs were added for that month. For the latest result, for the upcoming data, we have a forecast of 224,000 jobs. So, what is important is to take note of this forecast because if the actual number comes in higher than the forecast, right? This means that the US labor market is still robust, it is growing, continuing to add jobs, then this would be positive for the US dollar. So if the actual number comes in higher than the forecast, we are likely to see demand for the US dollar pick up. And we will see, naturally, we can expect the dollar index to rise, dollar yen to rise, and of course, we would see euro fall and cable fall as well. So that is why it is important to take note of the events that are coming up and how to interpret the events as well. Right, so we have the forecast number, we have the previous month's number, and by looking at the forecast and actual number, we are able to interpret how this data point is going to impact the particular currency or the relevant currency pairs. Okay, so this is Forex Factory. Um, okay, and if I go back to my slides, right? Okay, so all these websites here can be found on Forex Factory as well. So, for example, this is BEA's Bureau of Economic analysis. So this would give us GDP data from the US. So when you see GDP data on Forex Factory and you click on the folder icon and go, it will bring you to this website. This is ISM. So this will take you to the ISM website. So last night we had ISM manufacturing data from the US. So if you go back to Forex Factory, let me choose my starting date as yesterday. Right, so we had ISM manufacturing PMI data. So you can see they've highlighted the manufacturing PMI index and the prices index as well. Okay, so the forecast was here, previous month's reading is here. So we can see the actual data came in worse than the forecast. So in this case, a reading below 50 means the manufacturing sector is contracting. So that means economic activity, at least manufacturing activity, is slowing down in the US. And we can also see the prices index. Prices index measures the level of inflation in the manufacturing sector. So if this is falling, you can see it's coming in lower than the forecast and the previous month's data. It means that inflationary pressures in the manufacturing sector are retreating strongly. So when you have a combination of slower economic activity and slower and falling prices, this is negative for the US dollar. This is what we saw initially, but the move wasn't wasn't sustained, right? So this news was released at 2 p.m. GMT yesterday. So if you go to our chart, this is the chart of the dollar index. And if I go to 1400 hours, we can see here on my crosshairs that when this news was released, dollar index opened at about 102.95 and it dropped as low as 102.75, right? So it dropped about 20 pips. And but prior to that, the dollar index was already falling, and this news event drove dollar index even lower, but the move was not sustained, right? In this case, for this particular instance, the move was not sustained, and we saw a lot of buyers come back in for the dollar index. And similarly, today, this morning, during Asia trading hours, despite yesterday's fundamental data, which would suggest that the dollar should be weak and should continue to sell off. Actually, the opposite is happening. So we do see strong demand for the US dollar. Hence, dollar index is going higher despite fundamental data, which is suggesting dollar index to be weak. Okay, so do take note of that. And this is how we can use uh, the economic calendar to highlight the main events that for the week and how we can interpret the events and relate it to the relevant currency pairs, right? Okay. Um, so if I go back to my slides, right? So okay, same thing. So BLS is what I showed you earlier, right? Bureau of Labor Statistics. This takes us to uh, non-farm payrolls data. This naturally will take us to CPI. So don't worry. You can take a screenshot of this. That's fine. Not only if you take a screenshot, but do take note. Everything is found on forex factory as well, right? For example, if I click on the folder icon for ISM manufacturing, click on latest release, it takes me to their website, right? So I have the report and charts for both manufacturing and services data, right? So services will be released later this week on Thursday. So we can see here ISM services PMI, services PMI will be released on Thursday, 6th of July, right? And then naturally this will be updated. So obviously this is now showing May's result, okay? And we can see the headline services PMI plus all the breakdowns of the indices. And if you just quickly look at the PM manufacturing PMI, we can see it is for June, right? And we can see manufacturing activity in contraction territory, and we can also see the prices index also has fallen sharply as well, right? So when you have this sort of data coming in, generally it is negative for the US dollar, and which would be negative for the DXY, which is what we saw last yesterday at 2 p.m. GMT. But as again we mentioned, there's still strong, relatively strong demand for the dollar. So despite the fundamental data suggesting dollar to fall, is actually holding up quite well. Okay, right. So these are some of the data links. So you can take a screenshot of this, and also do take note everything's found on Forex Factory as well. Okay. Right. Okay. So since this is introduction to Forex, so next we'll cover central banks, right? As I think many of you should be familiar with this, right? These are the main or the major central banks from around the world. So, of course, we have the biggest and the most important one, which is the Federal Reserve, otherwise known as the Fed. Then we have the European Central Bank or ECB. Then we have Bank of Japan, Swiss National Bank, Bank of England, Bank of Canada, and then the RBA and RBNZ, right? These are the major central banks, and we should be keeping an eye out for whenever they have any cash rate announcements or interest rates announcements and policy statement updates as well, because they it will always end up being a market moving event. Okay, so like as we mentioned, so in about 1 hour the Reserve Bank of Australia will be announcing their cash rate. They're likely to hold the cash rate and also quite possibly have a dovish policy statement, because the reasoning for this is because last week's Australian inflation data has shown that it's been retreating, it's been slowing down, so there's no additional reason for the RBA to be hawkish in today's meeting, right? So it's quite likely that we may see the Aussie dollar fall off, or the Aussie dollar fall when this news is released. Okay, so these are the major central banks. Okay, then we'll cover what is the dollar index, right? DXY or DXY. Okay, so just a brief history. All right, so DXY or the dollar index was established back in 1973 after the Bretton Woods Agreement was dissolved. Basically, this was the agreement where currency markets were pegged to the price of gold, especially the US dollar, right? The value of the US dollar was pegged to the value or to the price of gold, but this agreement was dissolved, and then a dollar index basket was created. This would be a weighted average of the US dollar relative to the following currencies. Okay, so these were the main trading uh, partners for the US back in 1973. But obviously, the euro hadn't been created at that time. So it was actually the German Deutschmark, as a reference, if I'm not mistaken. The German Deutschmark was one of the first currencies to be included in the basket, along with the Japanese yen, the sterling pound, Canadian dollars, Swedish krona, and Swiss franc. So do take note. Now, of course, with the establishment of the euro makes up 57, almost 58% of the dollar index, then followed by the Japanese yen making up almost 14%. Right. So basically, we have majority of the basket weighted by the euro and Japanese yen. So almost 72% is weighted in the favor of the euro and Japanese yen. So what this means is if we see very strong demand for the euro, very strong demand for the Japanese yen, then this would mean that dollar index is going to be very weak, right? So if you see the euro gaining very strongly, you see the Japanese yen gaining very strongly, then it's quite likely it means that the US dollar is selling off, and hence the dollar index should be falling, right? And of course, we have the pound sterling making up 12%, Canadian dollar 9%, Swedish krona 4%, and Swiss franc with almost 4%. All right, so this is just a quick background on what the dollar index is, how did it come about, and what are the components, and more importantly, what is the weightage of the relevant components in this basket. Okay, so some of the economic data, right? Okay, we can see so why ISM prices is important, because it's quite relevant in today's context as well, because we saw the new yesterday's manufacturing data come out being released. So we can see that ISM prices, the average of ISM prices between manufacturing and services data uh, tend to lead CPI data. So when we saw ISM prices rising very sharply, we were expecting CPI to rise sharply as well. So when this happens, it leads to an inflationary environment, and that means central banks are going to raise interest rates to combat inflation. Right? They need to tame inflation, and the way they can do it is to raise interest rates to make borrowing more expensive, so that industries and households slow down on their spending, on their capital expenditures for businesses, and so on and so forth, right? So when you're trying to slow down spending at an industrial level or business level and at the household level by raising interest rates, you could potentially see inflation start to peak and turn lower, which is what we saw after that in the second half of last year. Right, so this is how we can use such economic data and try and predict where inflation is going. So you can see this chart is showing us from 2003 all the way to 2000 and to the present time. Right, so you can see the ISM prices average generally tends to lead the CPI data. So in a way, it is a good way of predicting where inflation is heading in the US. All right. And then once we know where inflation is heading in the US, we can also try and at least predict what the central bank, in this case the Federal Reserve, will do to combat or try and tackle inflation, right? Okay, this is just one example. All right, okay, so let's move on to the charts, right? Okay, and yeah, okay, let's go on to trading view now. And we'll start off with the dollar index. Okay, so here my chart is showing the dollar index. I'm going to go on to the weekly time frame first, just to see exactly, to give us some context to see how much the dollar, the US dollar has gained in strength, and hence dollar index will rise as well. Okay, so we can see dollar index, at least for the last 8 years, it's been ranging between 90 and about 103, right? So between 2015 to earlier uh, of last year, to the first half of last year, dollar index was basically ranging between 90, roughly 90 and 100, right? Okay. But because of inflation, coming seeping into the market, into global economies. Central banks have to tackle inflation, and the only way they can do that is by raising interest rates. So when the Federal Reserve embarked on its hiking cycle starting in March of last year, they were very aggressive, raising interest rates by 75 basis points. Okay, so what is basis points? Okay, so basis points, you just have to remember that anytime you see any news article or a news headline and they're talking about central banks raising rates by 50 basis points or 25 basis points, you just remember you take that figure and you divide it by 100. So that means 50 basis points means 0.5%. So 50 divided by 100 gives you 0.5, which means in percentage terms, they are raising interest rates by 0.5%. So similarly, when the Fed was raising rates last year, raising the rates by 75 basis points at each of the first 4 or 5 meetings. That means they were raising interest rates by 0.75% or three quarters of a percent. Okay, so because they were raising interest rates very aggressively, demand for the dollar started to pick up. So hence, um, the value of the dollar index would rise very sharply. So when you see the dollar index rise sharply, naturally we will see during the same period the Aussie dollar falling, right? Falling aggressively. We also saw the euro falling much more aggressively. We saw the pound similarly falling very aggressively. And of course, the dollar yen naturally would be rising very high. Okay. And one thing to take note of this, while almost all central banks were raising interest rates last year, right? If you go back to the chart, I mean, to the slides, you can see these are the major central banks. Almost all of them on this list were raising interest rates quite aggressively, except for one, right? The only bank that did not uh, raise interest rates was the Bank of Japan, right? Up till date, they have still maintained their ultra dovish monetary policy stance. They've kept interest rates, they are in the main interest rate at negative 0.1%, while while the other big banks, central banks, have over the course of the last 18 months have raised interest rates aggressively and are still keeping them high, right? So what we have is basically a divergence in monetary policy actions. So the Fed, ECB, Bank of England, RBA, RBNZ were all raising rates while Bank of Japan kept its rates at negative 0.1%. So when you have such a big difference in policy actions, or what we call divergence in monetary policy, it is very likely we are going to see that take play out in the relevant currency pairs. Right. So if we now go back to trading view, so I'm on dollar yen. I'm on a weekly time frame, so you can see the Fed started raising rates aggressively from March of 2022 onwards, and during this period, we can see the dollar yen go from start of the year what is it, about 115? Yes, at the start of the year about 115, going to as high as 151. So what we are seeing is a strong devaluation of the Japanese yen. And if I were to change my time frame into the to switch to the monthly time frame, we can see that this when the dollar yen broke above 150 last year in about October of last year, right? It had actually hit a 30, what is this? This is a, yeah, 23-year high, right? So you can see, right, the last time dollar yen was this high at about 147 was back in um, August of 1998. So basically, it was almost a 22-year high, right? So this is how much the dollar yen gained, meaning the Japanese yen was being devalued very strongly, right? This is purely led by fundamental reasons, which was the divergence in monetary policy actions between the Federal Reserve and the Bank of Japan. Remember, as we said, Bank of Japan kept interest rates at negative 0.1% despite rising inflation, while all the other major central banks were raising interest rates very aggressively, led by the Federal Reserve. So that is why we saw this huge move in uh, dollar yen. Okay. Okay, so now we may see here. Okay, so why did the dollar yen peak in October, right? Going as high as 152. And then why did it suddenly reverse and drop sharply over the next couple of months? One of the reasons, or the main primary reason for this, is the Bank of Japan actually intervened in currency markets. So if I go to Google now and I type BOJ intervention, right, this news was covered uh, last year by media outlets, right? Even on any international news finance outlets, as well as your local media would have covered this as well. So basically, the Bank of Japan announced foreign exchange intervention or FX intervention. So what this means is that because the yen had devalued so much, they needed to. So when the value of the Japanese yen drops, it makes Japan's imports more expensive, right? And then if your imports become more expensive, your local producers, services, and goods become more expensive as well, right? Especially for the imported items. So because of that, they needed to control, or they needed to get the dollar yen under control, and so they intervened in the foreign markets by selling their treasury reserves, right? Or their foreign reserves, sorry. So Japan, along with China, are one of the biggest holders of U.S. treasuries. So the Bank of Japan started selling its foreign reserve aggressively. So they're selling the US dollar, and then they were using the proceeds to buy back the Japanese yen in the open market. So that is why during this period after the intervention was announced, roughly in about September, October, we saw the dollar yen peak and started to see it fall sharply for uh, a period of 3 months. All right. So it's also important to take note of such fundamental policy changes by central banks, because they really drive huge moves in markets. And if we understand the news or what they're doing in the policy actions, we are able to capitalize on uh, on that move. Okay. So similarly, prices, the dollar yen retraced as low as 128 earlier of this year, but then we can see that after the first intervention had played out, the Bank of Japan had stopped selling its foreign reserves to buy back the yen. We can see that price stabilizing and starting to rise again. So this rise in dollar yen again is led by the fundamental difference or the policy divergence between the Federal Reserve and Japanese yen and the Bank of Japan. Right. So intervention. They announced the intervention. They acted out the relevant tasks to play out the to carry out the intervention, and then once they stop intervening in the foreign market, in the open market, you can see demand for the dollar yen pick up again. Okay, so this is how we can. This is why it is important to pay attention to central bank news, interventions, policy actions, and also to identify monetary policy divergence so that we can try and capitalize on such moves. Okay, so since we are on Japanese yen, let's just go back into the daily time frame. Let's do some analysis as well, so we can try and see where uh, this forex pair could be headed, right? Okay, so let's try and identify support and resistance levels. So we'll use, okay, naturally we can use this uh, level here as probably our first resistance, but this is quite far. So let's just label this as second resistance. Remember, this is a daily time frame, but later once we have identified the resistance levels on the daily time frame, we'll zoom in into the 4 hour time frame to identify levels that are more actionable or more relevant to where price is currently trading. Okay, right. And then if we look here, I also see a nice overlap here as well. Relatively okay, so we can see price running into resistance at 145.90 here in September of last year. Then price found support over a few days back in October, towards the end of October, before price finally broke through. So I think looking at a nice overlap here, this would be potentially a resistance level that is much closer to where price is currently trading. And we can probably label this as our first resistance. Okay, now if I zoom out a little bit, can I see any nice overlaps? No, if I now this is going all the way back to 1998, right? As we saw on the monthly time frame. Okay, so these are the resistance levels for dollar yen or the daily time frame. Let's try to identify certain support levels. Okay, so I can see a pretty decent overlap here as well. We can see uh, price, right? Let me just change this to first support. Okay, we can see the dollar yen finding support here back in September and yeah, mid September to end September of last year. Price found support here before breaking higher. And of course, price retreated back. And then when it rebounded in the end of November, it ran into resistance here again and fell. So we can see multiple instances where this level and 142.06 has acted as significant support and resistance areas for the dollar yen. So hence you can see price here in more recently in towards the end of June, price running into a little bit of resistance here before finally breaking out. So naturally once what is was previously a resistance will now become uh support. Okay. And for the second support, okay, let's just do Fibonacci retracements as well. We can do a Fibonacci retracement from the swing high on 24th October, right, going to the swing low on 16th of Jan. Okay, so we'll pull up all the Fibonacci levels. So as price moves up and breaks through these retracement levels, they become invalid. So 23 is no longer invalid, 38, same for 38, same for 50, and same for 61. So what we can see here, the only level left would be 78.6. So we're just going to keep 78.6%, right? So we can see that this retracement level at 78.6% also lines up slightly above this overlap resistance level as well. So you could say this is probably the next zone where we can expect significant resistance for the dollar yen. So what I'll do is also I'll just highlight this as a zone just so that it's much more clearer. And potentially this would be wait, right. Okay, so between 145.90 to about 146.60 is would be our immediate resistance zone for the dollar yen. Okay, we can also do a Fibonacci retracement level from this swing low on 16th of June to the recent swing high back last week on 30th of June. You can try and identify various support levels. Okay, so we'll pull up all the Fibonacci levels. So we can see, okay, 23.6% over here, right, which is slightly below the first support. So, and here, okay, so I think on a daily time frame, this level at 38.2% is probably a good level to identify as the second support because we can see a combination. We have two factors contributing to this second support level. We have the retracement, Fibonacci retracement at 38.2%, and we also have a pretty decent overlap over here. So we can see price running into resistance in December 2022, running into resistance on the 8th of March, as well as on the 1st of May. And then after breaking higher, we can see that it actually found support just above this level back in early June as well. So we have multiple instances that allow us to identify this as a key overlap support that also lines up with the 38.2% Fibonacci retracement. Okay, so what I'll do for this, I'm just going to keep 38%. The others are not valid, are not valid, they're not relevant, sorry, they're not relevant in the current analysis. So we'll just remove them and keep 38%. Right. Okay. So on a daily time frame, by using a combination of Fibonacci retracements and overlaps, we have identified the second and first supports as well as the second and first resistance levels and also zones for dollar yen. Okay, now as I said, we'll now go zoom in into the 4 hour chart to try and see what are the more actionable levels that we can work with, right? So this is on a daily time frame to establish a high level view of the dollar yen. Okay, so here I am. Okay, this is a 4 hour chart. Okay, so we can also use Fibonacci retracement here. So I think on the shorter time frame, naturally the starting points are going to be different. Starting and ending points are going to be different. So I think I will use this swing. Let me see. Let's see. I can use the swing low on 8th of June to the swing high 30th of June. What we want to see is the trend line capturing the price structure quite well. So what do I mean? What is the trend line? So okay, I'm going to change this to a maybe slightly brighter color so it's more visible. Right. So as you can see here, this orange dotted line is the trend line of the Fibonacci tool. So when the trend line captures the price structure as close as possible, it means that the subsequent Fibonacci retracement levels are likely to act as potential support. Okay, so in this case, if anyone's not familiar with Fibonacci retracement tool and how to use it, basically when we are, it always starts from the left to right. Doesn't matter if you're doing it on a bullish trend, a bullish move, or a bearish move. We always start from the left. So in this case, we start from the swing low and we go to the right to the swing high. Okay, so this is how we do the Fibonacci retracement for a bullish move. And the trend line should capture the price structure as close as possible. Because when that happens, the subsequent retracement levels are more likely to act as significant support areas or levels for that particular instrument. So, as an example, if I were to do Fibonacci retracement on a bearish move, so for example, I'm going to take this example here in May. So I'll take the swing high on 2nd of May and go to the swing low on 4th of May. Right. So I pull up, you can see the orange dotted line here has captured the price structure very well. So naturally, uh, the subsequent Fibonacci retracement levels will be should offer pretty significant resistance. So in this case, when once the bearish move has been formed, meaning we have identified the swing high and the swing low, we can do the Fibonacci retracement, and the subsequent levels here will be highlighting um, potential resistance levels. So in this example here, on this in this instance, we can see that 23 after making the swing low on 4th of May. Dollar yen bounced higher. It broke through the 23.6% Fibonacci retracement level very easily, right? It did not offer any resistance. Where it actually did find some significant resistance was around the level at 38.2% Fibonacci retracement. So at this level, which was at about 135.20 to 135.50, that's where dollar yen saw some significant resistance before price started to pull back quite sharply, right? So we can see here that the first resistance retracement level did not offer any resistance, but the second one did. So do take note that the retracement levels offer a guide, right? They do not offer any certainty or guarantee that price is going to find resistance at this level, right? As we can see in this example, price cleanly and easily broke through the 23.6% retracement level, but found resistance at 38.2. So do take note that any level here that's identified by Fibonacci retracements offer only giving us an indication or a guide to where potential resistance levels could be, right? And then of course you can use this tool with any other indicators that you may use to identify support and resistance areas, right? So what is important is to understand how the indicators work, combine it with the ones that you're familiar with. For example, if you're using Fibonacci and you're using other indicators as well, maybe two or three indicators that you understand well and you can do the analysis uh, correctly. It will likely to help you identify higher probability or high probability resistance and support levels. Okay, so in this case, here what we're using is we are using a combination of Fibonacci retracement tool and overlaps. Right, we're looking for significant key overlaps where price has reacted off that particular level, be it as a resistance or support. So we can see here 38.2 acted as significant resistance before retracing. And again, 50% did not offer any resistance. It actually broke through quite cleanly. Where it found some resistance was at 61.8%, right? 61.8%. It found resistance for a day or two, pulled back a little bit before breaking higher. So it's important to note that the retracement levels offer a guide, right? So in this is an example on the bearish moves. So I'm going to delete this now and focus on where price is currently trading. And in today's context, we can see that this Fibonacci retracement level captures the trend line, captures the price structure very well. And these subsequent levels here are highlighting potential support areas or levels. Right, so we can see 23.6 is here, 38 is here, 50 and 61. So what is important to note that we can see that 50% retracement level lines up with this overlap which we had identified earlier. So even on the 4-hour chart, we can see that the level of 142.06, you can see multiple instances where price has reacted off this level, be it as a support or as a resistance. And it also lines up quite nicely with the 50% Fibonacci retracement level. So we have two factors that uh, contributing to this level as a significant support level. Okay. Now, what about something that's a bit more closer? Okay, so I'm on the 4-hour time frame, and we can also see that there is a slight overlap. We can see a pretty decent near-term overlap here as well. Right. So I'm just going to highlight this as a intermediate support. So I'm going to put this as here. So we can see um, back last week, 27 June, we can see price running into a little bit of resistance here before breaking out and finding support on Wednesday here and finding support again at the start of the week before breaking higher. And again, just like yesterday, finding support here again and going before dollar yen rebounded. So we can see we have a nice overlap here that has started since 27th of June, so for almost a week, right? So this, when we see price reacting above a particular level, be it as a resistance or support, we should be able to uh, identify it and highlight it as, in this case, currently now, it would be a potential support. So this is be my first immediate support level for the dollar yen on a 4-hour time frame, right? And of course, the swing high would be our immediate uh, or rather intermediate resistance level. So naturally, if price breaks through the swing high at 105.10, then it's very likely it's going to push towards the first major resistance area at 105.90, right? This is where we can expect dollar yen to run into some significant resistance should the swing high be broken. Now, to the downside, so far, price has managed to stay above 144.20. So it's very likely we could see price bounce higher. Like as we said, the divergence between the Federal Reserve and the Bank of Japan is still in place. So we are like, and there's no new intervention news coming out of Bank of Japan. So it's quite likely we could see dollar yen move higher. So of course, if it breaks through this first intermediate support at 144.20, we could see price maybe find support around the 23.6% Fibonacci retracement. Okay, so this is dollar yen. Okay, maybe I'll just clean up and just keep 23 and 50. Okay, no, I'll just keep everything here. So this would be the analysis for dollar yen on the 4-hour time frame and how we can use it. Okay, and then okay, since we have Reserve Bank of Australia coming up, let's just do end the session with looking at the Australian dollar. All right, let's do analysis on the Australian dollar. So okay, Okay, so we can see, okay, this is the daily time frame. So as expected, uh, yeah, we saw the Aussie dollar sell off aggressively. I'll just switch to a weekly time frame before we zoom in onto daily. Right. So yes, so when the Federal Reserve started raising interest rates aggressively in 2022, we saw the Aussie fall from as high as 75 cents to go as low as 62 cents, right? So we can see how much the Australian dollar was devalued or lost its value. And then after that, when we had the intervention by the Bank of Japan, right, they were selling their foreign reserves, so selling like US dollars to buy back the yen. You could see the dollar being sold off across other currencies as well, against other currency pairs as well. And you can see Aussie dollar climb or rebound strongly from 62 cents to go as high as 71 cents. And then at the start of the year, we saw demand for the US dollar come back in, and now we see the Aussie falling. Okay. Now, since we have the RBA announcement coming up in about 40 minutes or less, and we know or not know, it seems that it is quite likely that they are going to keep interest rates on hold, and they may have a very, not very, they may have a dovish outlook because of inflation data falling last week in Australia. So inflationary pressures are receding in Australia. So it's quite likely that they will maintain interest rates steady at 4.1% and have a dovish outlook. So this is potentially negative for the Australian dollar. Okay, so let's see. Okay, this is a daily time frame. I'm going to do, okay, I'm going to use a Fibonacci retracement from this swing high on, what was this? April to this, of last year to this swing low in October. Oops. Okay, so as we can see, when price makes the swing low and moves up, it breaks through all the other levels. So we'll just keep 61 because we can see that's where price ran into resistance in January this year. Price ran into resistance at the 61.8% Fibonacci retracement. So we'll just keep 61. Okay, and then we can also do, can we do a Fibonacci projection? Let me see. Okay. And okay, let's see if there's any overlaps as well. We can see, hmm, probably no. Okay, I think I will use this as a more, as probably as the first resistance for now. It doesn't overlap well with anything else, but okay, that's fine. And as the first support, probably this recent swing low in the middle of May would be our first support on the daily time. Oh, this is weekly. Sorry, let me switch on to the daily. Okay, right. Okay, that explains it. Okay, so okay, that's fine. You can still do it. Okay, this, okay, the trend line doesn't capture. It looks better on the weekly time frame, right? If when I look at it, it looks better on the weekly time frame. But when I go and zoom, the daily time frame, it doesn't look as good. But okay, let's just keep it on as a reference for now. But we do see a nice overlap as well, right? You can see price running into resistance here at 71 cents back in January and also last year, August as well. Okay, so we have two instances where price ran into resistance. I think we'll just keep it here at 61. Okay, first resistance, probably, yes, we can see it around here. This is also probably a decent level. So you can see price finding support here at 68 and 68.73, and then finally running into resistance. I think this is a pretty good first resistance area on the daily chart. Then we can see that the first support would be around here at the recent swing low. Okay, we can also do a Fibonacci retracement. Is this okay? This is still not so bad. Okay, no, price has actually, see, you can see the trend line not capturing the price structure cleanly or as close as possible. So I personally would not use Fibonacci retracement on this part of the move. Yeah. But if I do a Fibonacci retracement here from this swing low to swing high, this is pretty okay. It captures the price structure quite well. It's not perfect, but it's pretty well. And let's just put up 78.6. You can see, okay, so we have 61, which has already been broken and gone higher. So you could say that this six, price found support just under the 61.8% retracement level, didn't offer support above it. So, however, it did find support back in March and April before finally breaking through. Okay, so we'll just keep that just as a reference. Although, do take note that 61.8% now is no longer valid because price has broken through this level at the end of May. So the next support level for when looking at retracements, Fibonacci retracement would probably be 78.6%. And in terms of an overlap, we're going to use the swing low here on 25th of May as our first support. Okay, now this is the daily chart. Okay, we can also do a Fibonacci retracement from this swing low. And was this May? Yeah, the start of June to the swing high last the mid June, and 78.6 is there. 61 is broken, so we'll just keep 78.6. Okay, and right. Okay, now I'm going to zoom in onto the 4 hour time frame. Right. Okay. So now that we're on the 4 hour time frame, we have identified the resistance and support levels based on the daily time frame. Now we're going to try and identify closer support and resistance levels on the 4 hour time frame. So naturally, we can use this swing low last week as a potential support level or support overlap. Okay. And then in terms of immediate resistance, we can see, okay, let's just do a Fibonacci retracement as well. So here, this swing high to the swing low, pull up all the fibs. Let's see. Okay. So we can see price breaking above 23.6% Fibonacci retracement. And previously, you could argue that this was also a pretty, there's an overlap here as well, which has now been broken, right? See, price found support at what level is this? 66.70 before breaking through, then finding some resistance here last week before now finally breaking through as well. So we can see that we have a combination of an overlap level that aligns with the Fibonacci retracement at 23.6%. Okay, then, but this has now been broken, so obviously this is no longer valid. So what I'm going to do, this is now let's look for the next resistance level. So we can see that the 38.2% Fibonacci retracement level lines up quite well with this overlap over here as well. If I go back here, okay, you could argue, right? So you can see a price running into resistance here on 27th of June, also on 7th of June, and also coming quite close to this level here on 23rd of May. So we have a overlap here that aligns slightly above the 38.2% Fibonacci retracement. So to the upside for the Australian dollar, I think we can expect to see some significant resistance around this level, right? And we can also see something that's a bit closer. Okay, maybe I would also highlight this in green now because you can see that. Oh no, no, this is price is currently above it, so you could you could just about argue that if the news is dovish, right? The statement is dovish. The RBA comes out very dovish. Let's zoom in a bit. You could argue that if that's were to happen, and if price breaks below this level at 0.6668, it's very likely we're going to see Aussie dollar at least make a move towards the first swing low here at 65.95. And if also that gets broken, then we can expect it to drop towards 65.50. All right. So do take note of the immediate support and resistance levels for the Aussie dollar. And we have RBA announcing their cash rate update in less than 30 minutes. So do take note of that. We have one big event coming up already where we can expect Aussie dollar to have some significant moves, right? So do take note of the immediate support and resistance levels for the Australian dollar. All right. So this was just a uh, introduction. So this webinar was covering an introduction to forex market. So let's just round up and and the webinar by just recapping the main points for today. Okay, so do take note of the major central banks, the relevant monetary policy actions, the meeting schedules, and do look out for any interventions as well. So as we can see, dollar yen has started to rise strongly again. Now, will the Bank of Japan uh, intervene in the open market? It waits to be seen. But if an announcement is made, then we can probably expect to see dollar yen to find resistance and perhaps start to retreat again, retreat strongly as what we saw from October of last year, right? So that's when their first intervention was announced by the Bank of Japan back in was it October of 2022, and then we saw the dollar yen peak at 152 and started to fall sharply because of the action by the Bank of Japan. So if another intervention action is announced, it is quite likely we may see something similar happen again. So that is why it is important to take note of what central banks are doing, what is the monetary policy stance, when are the upcoming meeting schedules, and is there any intervention carried out by any major central bank in the open market. And we have covered the US dollar index or the DXY, how it came about, what does it comprise, which are the currencies that make up this basket, and what is the weighted components of each. What is the weight of each component in this basket? And we've also looked through Forex Factory, where we can identify key economic data events, GDP, PMIs, inflation, employment report, as well as central bank meetings. And from Forex Factory, we are able to access the respective websites of that particular data or news, and then we can, if you wish, we can study that piece of information or data point in more detail. All right. Okay, so I've come to the end of today's webinar series. I hope this has been a good session for all of you. Yeah, apologies on the delay for starting this webinar. We just ran into a bit of technical difficulties, but otherwise we are good. And yeah, and yep, do take note of any upcoming events, and yeah, look forward to seeing you. All my colleagues will be seeing you for any upcoming webinars by XM. All right. Take care, everyone, and thank you for joining today's session.